the bank's Regulatory Excellence Office. As I said, we will be recording. Mark Caltagirone is with us today also. Mark joined Herbein, a local accounting firm, in 2015, although I'll let Mark explain that the name will be changing soon as the firm is merging with someone else. But Mark has long been a consultant to small businesses across Pennsylvania and is a consultant in the Management Advisory Services Department at Herbein. He was previously a partner at another leading regional CPA firm and senior vice president in commercial middle market group at Santander Bank. Mark is responsible for performing closely held business valuations, intangible asset appraisals, and providing litigation support services. Finally, our other panelist is Katherine Tohanczyn. Katherine's a partner with Starfield and Smith, where she focuses her practice on commercial financing, real estate, and corporate law. She has extensive experience preparing and reviewing loan files for SBA 7A and conventional commercial loans, as well as drafting, analyzing, and negotiating a wide range of loan and finance documents. We appreciate having these real experts here with us. I have to confess, I kind of felt this morning like I was walking into an old joke, a banker, a lawyer, a CPA walking to a webcast. But these are the people who will really be able to help you think through your process. And before we get into real specifics, I guess where I'd like to start with any of the panelists who want to jump in here is, I wake up one morning and I say, I want to buy a business. What's the next thing I should think? Mark, you want to dive in there?
Sure. And you hear that, Dave, not infrequently, but it's really important to narrow the focus of what type of industry a business might be in for which you are looking. We hear, oh, anything. And then when you ask a question like, okay, how about a restaurant and a bar? Oh, no, not that. Or how about retail? Oh, no. So those may be the right answers, but I think the most important thing is to narrow the focus of the industry. It doesn't have to be identify the name of a company that you're seeking to buy or what you're starting, but to at least narrow the focus so that you can determine, where your expertise lies, generally where your experience is, and those are really key factors in my view.
Katherine, Michele, what do you think about that? Is Mark onto something like? Yeah. Some investors that say only invest in what you actually know yourself and understand yourself. Does that fit with buying a business as well?
I couldn't agree more with what Mark is saying. And there's a lot of venues for people to look for businesses being sold, websites, transactions, and sometimes individuals focus on what's the revenue, what's the cash flow, do I think I can repay that loan? But really focusing on something or where you might have transferable skills is really important for how you're going to be able to succeed in operating a business. And it's also something that as a lender we look for. If someone, has never had manufacturing experience and now they want to buy a manufacturing business, well, there's a lot more involved in learning that type of a business than if you were to buy a service company. So I do think trying to narrow that scope with your skill set. And as Mark said, it doesn't have to be the exact industry that you're in, but you really need to think through, do I have transferable skills? And so many times you hear, buyers come up and saying, the business runs on its own. The seller doesn't really do anything. And that's 9 out of 10 times not the reality.
Very true. Right.
Yeah, just to echo off of that, it's the same thing. When you buy a business, a lot of times you have to think about why you're going into it. It's maybe you don't want to work for someone else. You want to have more flexibility. You want to have a legacy, those type of things. But in order to do any of that, there are a lot of things in a business that you don't realize until you get into the business, right? you have to run it, and you may or may not be a one-man show. You may have a great team behind you, but you still marketing, you have to do sales, you have to learn QuickBooks, you have to figure out employees, but you don't really know what that means until you're in that business. So So the more background you have, into the area, whether, it's a restaurant, a franchise, whatever it is, the easier the learning curve will be, because now you're not just learning, you can learn all the business stuff and not also the substantive stuff.
I
So-
think Catherine really hit some important points there to understand. You're going to wear a lot of hats, some of which our SBDCs can help you with, by the way, with the QuickBooks or some HR or some other regulatory requirements. But you're also probably going to fix the copier machine in the toilet. That's not really in our bailiwick. That's not our strength to help you with. But be prepared for all of that as you look at the business you're thinking you want to buy, kicking the tires and giving it some thought.
Just to echo quickly on what Katherine said, Dave, if I may, I like to say when you're buying a business, make a list of the 10 risks that you think you're going to face when you buy that business. And guess what? The first thing that goes wrong is the 11th thing on that list, which wasn't on the list at all. So surprises
So true.
are common. There's no one's fault that there's a surprise, but the first thing that pops up is that 11th thing on that list and wasn't even on the top 10.
That's a great point. So a lot of business people, whether it be another business, a building, the car they covet, they kind of say, oh, everything's for sale. It's just a matter of price. Yes, you might go online, as Michele said, and find some businesses for sale and say, boy, I have always wanted to have a pizza shop or a car detailing place or a landscaping operation. But how do you know it's the right price? Obviously, you want to make money. You want to be able to pay your employees and pay yourself down the road. How do you know that this is the right price to pay for that business?
Yeah, I can jump in, Dave. That as a CPA / business appraiser, which is, I'm not a tax professional, but that's what I do. And the most important piece of that analysis is forecasting future cash flows. A business derives its value from future cash flows. Remember the word future. Now, oftentimes, the history may be a proxy for future cash flows. It may be an indicator of future cash flows. And a lot of times that's what if it's an existing business, that's what you have to go on, is the historical cash flows. Right. What you will often hear is, oh, and this is more in I'll say in the old days when more businesses were cash. Today, fewer businesses are cash driven. Again, not cash flow, just pure currency.
Right.
You have to be careful of unreported income. Oh, I don't report 30% of the revenues, and you can't have it both ways. And our banker friends know that. You report a certain amount on your tax return, and maybe nobody ever really caught on, and maybe no big deal. But then when you go to buy a business or you're going to sell a business, that kind of, maybe you wish you hadn't done that so much. But that is that's an issue.
I feel the need to caveat this or footnote this on behalf of the SBDCs and say, please record all of your income and pay all of your taxes. Word from our sponsor. Great points, Mark, on the valuation. And when we get to that price and we decide whether it's fair and appropriate, it's unlikely, unless somebody just won Powerball or Mega Millions, they're not paying cash for it. So, Michele, they come into us and say, I want to buy a business. I think this is a great price. Give me the money. And you just go, do you want small bills?
I open my duffel bag and I take out the pack of, hundreds and say, here you go.
Yeah. How does this work? Yeah.
There's a lot of different ways to finance the purchase of a business. And in most of the transactions that I work on, we see a combination of sources to finance that transaction. Some smaller transactions people do buy for just cash. Maybe they get a home equity loan and pay for cash. Sometimes seller financing for some types of businesses is the only source of financing. But in most cases, I'm seeing a combination of borrowers putting in some down payment with SBA financing. That's always required for business acquisition. And one of the advantages of SBA lending is that you can buy a business with 10% of your own money going into the transaction and finance the rest. So it's normally some combination of that cash coming in. There's normally a piece of seller financing. A lot of times that's not just something that a lender likes, but from a buyer's perspective, it also keeps the seller from, just kind of keeps them honest and keeps them having a vested interest if they're not getting all of their cash day one and walking away. Another vehicle that we see used more frequently, I'd say over the last maybe 15 plus years, is there's ways that people who have worked and accumulated significant funds in a retirement plan, either a 401k or an IRA, who are leaving the workforce to buy their business. There's ways that you can tap into your retirement funds without having to take a withdrawal and take penalties and pay taxes on that, where you're actually investing in your business. So we really see a combination of ways that you can put together a financing package. And we evaluate kind of both the buyer and the sell side to determine how we can put that package together.
And you mentioned, I don't want to go too deep in the weeds for just one example, but you mentioned the seller providing some of the financing. And I suspect one of the times that you see that frequently, we're now in what some people would call the silver tsunami. I don't want to point fingers, but some of us with gray hair are getting ready to, retire, move on, do other things. And particularly with doctors, dentists, veterinarians, CPAs, attorneys, there are these small practices that have a junior partner that would like to take over the business. And knows the business, and frankly, that's the only way for the senior person to cash out, to get their equity back. It's not like if they're not a manufacturer, they don't have lots of plant and equipment they could sell or something, any tangible goods. So is that a frequent business transaction that you see, and how does that play into all of this?
I mean, it is, and I would say a lot of the advantages of SBA financing is, especially for those types of businesses that you just talked about, service-related businesses, professional, where there are not a lot of tangible assets. When you're looking to buy a business, many times the valuation or the purchase price is based on a multiple of cash flow, which is what's going to repay our loan. And we love that. But then there's not the tangible assets to back that up. So SBA financing, for those individuals who aren't familiar with SBA financing, that is a loan that a bank provides, guaranteed up to 75% from the Small Business Administration. So because the bank is getting a government guarantee, it allows us to kind of expand that credit box of what maybe a traditional lender might look for, which is collateral to support the loan. So in many cases, SBA financing and a combination of SBA financing and seller financing is a good way to put a financing package together for the type of business that is not asset heavy, that doesn't have that machinery equipment, doesn't have a lot of inventory or things to support that loan. So it's a very common, way that we put together a financing package.
So Katherine, if I'm coming to you with, either whether it be the small factory or my medical practice, and I'm the seller, or if I'm the buyer saying, coming to you and saying, I want some help here. What goes into that contract, that sales agreement? How do you structure the deal? What's your advice as an attorney of how do you protect your side of this bargain?
Sure. So, I mean, a little bit of a question, but because it's going to depend on a lot of, the different factors, the nature of the business, the amount, like how much the borrower or seller really want, and the level of protections and things like that. But usually the first conversation is, how are you buying the business? You can buy the assets of the business, you can buy the stock of the business, You know, and the difference there and why it's important is if you buy the assets, you just buy the assets. If you buy the stock, you buy the assets and the liabilities. So from a seller perspective, they want you to buy, a lot of times they want you to buy the stock. Now, if they have different divisions or different companies underneath that umbrella, they may only offer the assets. But a lot of times sellers say, no, I would happily hand over all of the liabilities. But as a buyer, you usually just want to buy the assets whenever you can, and have the seller retain any of those liabilities, any contract obligations you're not assuming, things like that. So that's your first question is, you know, identify the company and then how do you want to purchase it? Then we go from there to kind of bridge down, and then it will be what assets are you buying, right? And most of the time you're buying 99% of the assets, but there's a possibility that there's a separate division. Or, you know, usually it's a carve out on like, I'm keeping my truck, I'm keeping my phone, and I'm keeping my laptop type thing. And so that's part of the contract too, is very clearly defining what's being purchased and then what's being excluded. And then kind of going down, and then, you know, the next thing is, well, what's the price, you know, and then you'll value the price. How are you financing the price? You know, and then how are you buying it? Are you going to buy it individually, or are you going to buy it as set up an LLC or a corporation to purchase it? You know, as an attorney, we can give you different ideas, and there's different ways to handle that. I know a lot of times CPAs say it's a little bit better for certain tax purposes to buy it individually versus a company, but then a company helps you separate out liabilities.
Liability, right.
So you kind of have to look again, you know, what's the nature of the business and what makes sense? What are your goals? Really come down to how do we structure it and what does that look like? But those are the type of questions you want to be asking. And then when you're talking with a seller, make sure it's clear, hey, this is what I'm buying, this is what I'm not buying, and then you're documenting it in your purchase agreement.
Yeah, and I mean that's what we're going to write down. To get ready for that, we have to do the due diligence where we know what we're buying and what we're not buying, including like, oh yeah, by the way, did I tell you about the there was a storage tank here? Well, that was an underground storage tank. No big deal. You know, I'm pretty sure it's empty. I mean, there's all those kinds of little things, or oh yeah, you can see the books. I mean, there's these books, and then there's you know, Mark kind of alluded to that. So from a banker's point of view, a CPA's point of view, an attorney's point of view, where do I start now if I'm getting serious with due diligence and making sure I actually know what's going on here?
Yeah, I
Yeah,
mean,
that's- Oh, go ahead.
Oh.
I'm sorry.
that's okay. You can go, Mark. You can
You
start.
know, that and that's such a critical piece of the puzzle, Dave. And you know, it depends to some extent. You'll hear it depends, I think, a bunch of times in our presentation today, because guess what? It does depend. But it depends upon the quality of the underlying records, assuming it's an existing business as opposed to a startup, the quality of the accounting records and how reliable they are. It depends upon the sophistication of both parties. I was recently in a transaction where the buyer, small transaction, the buyer was knowledgeable and sophisticated. The seller, although they were very sophisticated and very knowledgeable about how to run their business successfully, most people have never been through the sale of a business, and they were not knowledgeable. And I told them right up front, I was representing the buyer. The most important thing was for the seller to get professional advisors, a CPA, an attorney up front. I've seen a lot of transactions die because there was a failure to have qualified professionals on both sides, and that's really important. But to be real specific, Dave, I was involved in a matter some years ago in which litigation occurred because there were some undisclosed liabilities in the form of accrued vacation pay and accrued workman's comp claims. These are not necessarily liabilities that should have been
On the books,
reported necessarily, but they were real, and the buyer had to assume these liabilities for accrued workman's comp, for accrued vacation, and it was the seller's accounting conventions to not record that, and then all of a sudden, voila, here pop out these big numbers, and then some ugly, expensive stuff started to play out. But those are two areas: accrued workman's comp. There are others, accrued vacation pay, that you really need your best to get your arms around, so that surprises don't pop up after settlement.
And I would add, I mean, like when we're a lender and we're looking to review a financial due diligence package, I think one of the things, obviously, you're going to want to look at for our perspective, the last 3 years of business tax returns and truly analyze what the cash flow looks like. Accounts receivable and accounts payable. One of the things that people don't always think about, but that's very important from a lender perspective, and I think should be important to a buyer's, what is your customer base comprised of? Are there customer concentrations? One of the things we do ask for is a sales by customer for the last 2 years, if possible, because you want to know, of that 2 million in revenues of sales, does one customer make up 40% of those revenues? Does it make up 5%? What is the composition of that? Are there contracts? So it's really trying to kind of dig below the surface numbers to truly understand kind of what those risks might or might not be. And Mark hit the nail on the head. And I'm not just saying this as, a plug for my co-panelists, but hiring professionals, accountants and attorneys to work for you is so tantamount, and a lot of borrowers don't want to spend the money, or there might be a business broker involved, and the business broker is going to answer all my questions and try and help with these things. Most individuals who buy a business, it's the first time they've done it, and it might be the only time they're doing this. And if I were doing something for the first time or the only time, I would want professionals to help me. And you really do want expertise who's going to look, individuals who are going to look out for your best interests. I mean, the bank is going to hire a counsel like Katherine to represent us, but they're representing the bank, and we're not going to do anything that's going to hurt you, but you need people to represent your interests. And I just saw a comment in there. SBDCs are a great resource for that. I agree 100%. And it doesn't cost you, a significant amount of money, and they can help you model and things like that.
Yeah.
So,
but that's, I think that's a fair point. So Will, what's the break point for SBDC consulting of where we want to help out a client and give them advice and everything else, but where we say, okay, this is as far as we really should go,
Sure. Of course. So our bread and butter is business plans, financial projections, coming up with market data, and giving you a holistic picture of the process. So we are we have a lot of breadth, but the depth only goes so far. So whenever someone comes to us, like, yeah, I'm thinking about buying a business, we echo a lot of what the rest of the panelists have said, but we say, like, you do need to go talk to them, though. Like, not everyone is a CPA. Not everyone does business valuation. Some folks were not lenders. So we say, you got to build the proper team. And so by building the proper team, you're going in with, getting the best advice, that you're not missing anything. Because, if you're going to be doing this for the first time, there's going to be things that just frankly, sure, you'll miss. So you bring in a good team. But whenever you're, going through that whole process of what's the value here of the business, what we can do here at the SBDC to help out is reviewing those documents with you as well. So do we see any sort of red flags? We can give you some sort of pointers, like you should probably go visit the business. I'm surprised at how many clients don't even go in and walk through the doors. And so, yeah, go take a look, see what the quality of the machinery is like. Communicate with the employees if you can. Try to do a little bit of digging. I advise my clients that you're kind of acting like a detective, trying to figure out what might be sort of skeletons in the closet. So I think it was Michele who mentioned about like a key employee or only having one supplier. Like those are pretty big red flags, if you will, right? Like if you have, I have one client where a Fortune 500 company is 80% of their revenue. They get 80% of the revenue from one client, and a lender wouldn't lend to them in for just an expansion loan. So how risky that could be, right? So to answer your question there, Dave, yeah, like we go through a lot of the basics, make sure we could advise on a lot of the different topics to get you started, but you have to go to the professionals for more help.
Yeah,
Right.
and to dovetail on some of the points, I'll tell a quick war story. I was involved in a transaction a number of years ago in which the buyer of a business reviewed the customer list, and it was properly and competently and fully disclosed and prepared. And one of the customers on the list that didn't represent necessarily a concentration, it was maybe 10, 12, 15% of the revenues. It just so happened that that customer was the brother-in-law of the buyer of the business. And whether it was discussed or whatever, when the business was sold, well, some of that business started to go away. So nothing illegal, nothing nefarious, nothing underhanded. He just didn't know that. So that impacted the cash flows of the acquired business. I'll also add, and if there's one thing from my perspective that over the years you could say, if there's one thing to take away from this discussion today that I see buyers and or sellers fall into a trap of, it's not on a timely basis engaging an attorney's services, wherever they come from, in whatever entity they are housed. But I've seen, I don't want to, as I think Katherine said, I don't want to, pay my attorneys, they're expensive. And nope, I advise just the opposite. If there's one thing to take away, involve an attorney as early as possible to avoid hopefully some pitfalls.
Yeah,
Right.
I don't want to stretch the metaphor too far, but I was thinking, for a lot of us who are do-it-yourselfers, home improvements and everything. Oh, I can put on my own deck. I don't need to go hire a contractor. Well, there's a whole lot of things that you do the first time that are mistakes, and you're going back to Lowe's or back to Home Depot and running back and forth and getting something else, buying a new tool and doing this, that if you were building it again, you would know already. But to Michele's point, this is the first time you're buying the business, maybe the only time you're buying the business. Whereas your CPA, your attorney, your banker have done this time after time after time. And like your contractor, they know, yeah, in theory, it seems like this would be easy. Just do this. And I would guess, Katherine, there are times too where you can kind of play the role. Mark used an example of the brother-in-law. I think we can all think of that. But a lot of times these transactions are between friends, colleagues, people who have some kind of relationship with each other, with one another. I would guess the attorney and the others, but the attorneys might be the one who are sort of the bad guy, who asks the impertinent question, who probe a little bit more, who ask the tough question and go, hey, that's great. I love that. Can you show it to me in writing? And can do those things that have to be done. That's a little tougher for the buyer and seller face to face. Would that be a fair characteristic, Katherine?
Yeah, I mean, I think, as much as most people are going into buying a business and trying, they think like it's logical, it's business, right? It's not personal, it's all about the money. The reality is that it's incredibly emotional to buy a business. You are going to, as you get through the diligence, especially if you identify you're going to identify a business that you love enough that you're willing to put money into it, right? And all of your blood and sweat and tears and everything over the next however many years, decades. So you're going to get invested in, you're going to get invested in the seller. And as you start unraveling things, there's going to be a natural instinct to, some people are very much like, no, open it up. But a lot of times when it's your first time, you just are so excited that you just want to buy it. So you'll ignore, you'll take the red flags and they'll all of a sudden just be yellow. They'll be like, oh, maybe it's not that bad, right? Like, we'll figure it out. Everything will be fine. Everything's going to be fine. It's going to work. I'm going to do this. I'm going to work as hard as I need to. Nothing will stop me. And there are just certain things that you really do need to be aware of and prepare for. And I always say, my recommendation is get an attorney that represents you as early as possible. And that's usually what we call the LOI, the letter of intent phase. You would ideally, a lot of times when you're with a seller, to get them to essentially like take it off the market. Sometimes they'll require a deposit, but at the very least, you have to do some type of, letter of intent, which is, I intend to buy your business, you intend to sell it, and here's the terms. And it's usually 1 or 2 pages, the general purchase price, like how you might be financing it. And what goes into that is something that you really should, if you can, have a lawyer look at it so that they can say like, hey, something like a financing contingency, like I don't have, if I put
don't get financing,
$30,000 down,
right.
right? But I want to say this is contingent on me getting a loan. And then I go and a bunch of lenders say, oh, well, I can't give you the loan if you don't have that contingency. It's just like buying a house. They may have the right to keep the deposit. So I always say, if you can, as early as possible, really before the LOI phase, you should have an attorney involved. If you're past that, that's okay. It doesn't mean it's too late, but you should still, look and just say, here's what I've done. And you'll see, like Michele mentioned, I primarily represent lenders a lot of times. And so people see me and they think like, representing the bank generally means the borrower is in good standing, right? So we want to make sure the success of the borrower. So our interests align, but we have a fine line between what we need for financing versus what a borrower should be fighting for from a corporate liability perspective, right? So, there are certain points where, we might say, okay, as a bank and in financing, this is what we need. But then borrowers will come back and their attorneys will say, well, that's great, but that's the floor. I want even more than that. I wouldn't buy the business without additional indemnifications or an escrow holdback or something else that a bank might not require. So just seeing another attorney involved, or, sometimes you'll hear like the seller has an attorney and so I'm dealing with them, or I have my broker. It's great to use those resources and to hear other perspectives, but you really want someone in your corner who's going to represent you if something happens. And that's where we talked about like identifying the issues. Well, once the issues have been help you identify them. And then once they've been identified, how do you document that, right? So you want to make sure, look, I'm not saying your purchase agreement needs to be 500 pages. I've seen purchase agreements, depending on the nature of the business, that, they can fit everything into 10 pages, right? Like it can be short and, not a bunch of old-fashioned legalese, but you want to make sure things are in there, like representations and warranties, that the seller has told you any contracts they're signing are assignable and they've gotten the consents. Does the landlord require consent to transfer? Does the franchisor require consent? Does the 3 top customers require approval prior to sale? Those are the type of things that you want to, identify. And then 2, once you have identified it, make sure that it's being documented so that if something happens, because that's, right, like if everything works out, that's ideal. But what we're here for is to kind of help you in the, like, what happens if something happens? And then how do you protect yourself? So you can go back to that contract and say, hey, I paid you $300,000, but the agreement required that you provide A, B, and C, but you didn't provide B. So now we have a contract issue, and whether or not there's something that can come back to you or something that you can do to protect yourself in that situation.
You said it'd be nice to be there at the letter of intent phase, but if you can, and I'm asking you to do this off the top of your head, so I get that sitting there writing it down and ordering them might be different, but what would be like the 5, 6, 7, 8 steps that you think are like, well, this is step 1, step 2 in the chronological order that I do them, and that may or may not mean then creating a document or some memorializing some agreement that goes to the next step, that goes to the next step, that goes to the final consummation of the deal.
Yeah. So usually, the first step is, one, I want to buy a business, right? And then it's, do I want to like, right. I think your first question is, do I want to start my own business or do I want to buy an existing business? Because there's pros and cons to a startup versus buying. If you decided I want to buy a business, Then I think it's identifying the type of the business. You know, is it a franchise? Is it a mom and pop? You know, like, you know, how long has it been around? What's the industry? Like all that stuff. You identify the business. You know, I don't think you need an attorney to go start talking to the seller to get general information. Like, you know, what's the background? How often do you work? How much are you paying yourself? Like, you know, how many vendors do you have? What are your general issues? Have you guys been impacted by tariffs? Are you, you know, what are your things? Like, ask them general questions. I think all that stuff's fine to make sure that you've actually identified a business that, you know, you're interested in, you want to do, and doesn't scare you. And then once you've kind of started, I think it'll become a little bit more natural. It'll be a little bit more like, hey, I'm feeling good about this. Seller's feeling good about this. We want to go to the next step. And I think that's when you want to turn to people like get a CPA, an attorney, and start saying, okay, hey, now I want to like memorialize this. So what's the next step? So that's, you know, talking to attorney. CPA will give you different pros and cons on how am I going to purchase it? Am I going to do it individually? Am I going to do it through a company? And then that's when you can formalize an LOI with the seller. And again, that's just kind of like, it's kind of like an initial contract where you're saying like, hey, I'm going to buy the business and you're going to sell it to me. So if anyone else comes in and tries to offer them more money, it's kind of off the table as long as you guys are negotiating, but you're still in the diligence phase, right? So you are still allowed to ask questions. Things are allowed to change. You know, this will be when your bank might ask for additional documents. You know, you're working with them to make sure you get everything. And then, you know, you should be asking things. You should be doing, like I said, so like customers would be looking at, they're going to pull searches and things like that. But you should also be, you know, looking into things. What happens if a lawsuit pops up, right? Maybe a seller, you know, contractors are always in litigation. So when I see a contractor that's being sued, I'm generally not super scared about it. But if it's like a med spa and they're being sued, I might be like, okay, hold up, what happened, right? Is this a one and done? Is this covered by insurance? Was this a bad employee? You know, is it all over Google and Facebook? Like, what does this really mean?
Risk.
So,
Right. Yeah.
you know, so then, and I would say that the diligence phase really is, I think, the longest phase of it. It's kind of like the dating before you get married, like, right? Like, so we're getting to know more about each other. We're asking questions, you know, maybe seller needs to start ponying up some money. And one of the things that we see a lot of is that everyone does an LOI and they're like, I'm buying your business for 500,000 and this is what I'm getting. And they feel locked in. I will tell you that everything is negotiable. If you find out that like a contract is about to expire, or when they don't want to tell the employees because they have a concern that the employees they like them and they're not going to follow you. I mean, you can go back and renegotiate the purchase price. If the valuation comes in low, you can go back and negotiate those things. Again, keep in mind the emotional, I don't want to lose this. You know, I want to make sure I can follow through, but that's going to be the longest phase for you. And then the most exciting phase is when you finally get to closing and then funding on your deal and getting the keys and kind of then being on your way. But I would say like do the initial diligence. And then once you're getting into the LOI, all the way through the diligence, and expect diligence
to a full contract. And
everyone thinks like I do an
time.
LOI and then I'm going to close tomorrow. But like, again, and one of my war stories I had is I had like a salon over in New Jersey where we told the borrower multiple times, it was like a 2-page purchase agreement. Again, sometimes that's fine, but it didn't have anything, no reps and warranties, no indemnification. It was just like, here's who's buying and you're buying the assets and here's the amount, and that's it. And we said 3 different times, are you sure that you're fine with this, that you don't want anything else? You don't want an attorney to look at this? And they ended up coming back. The seller basically like handed over the keys, and it was little things, right? Like they didn't pay any of their utility bills for the last 2 months because they knew they were selling the business. And they came back and they were like, well, but it's like $3,000 on all this stuff. And then they said to me, where in the purchase agreement is this? I need to go fight him. And I was like, well, we didn't require it for financing and you didn't require it as a borrower. So like, you can still fight him. I think you're still entitled to it, but there's no piece of paper that you can go to. So those are the type of things that I say, like, you know, they kept coming back and I said, remember 3 times when I said you should get an attorney? Because an attorney would have said, in order to do my job, we need to look at these 3 things and document them. And they would have helped them understand the importance and kind of pull back, on that
and we talked about
emotion.
how the attorney, the CPA, and then the banker can help with that, and even the SBDC. Somebody put in the chat and asked about brokers. And I would imagine brokers provide a whole lot of experience and background and some good questions and everything else. And I'm going to work from the assumption that 99% of brokers are scrupulous. At the same time, I have to confess I have a suspicion that, hey, a broker only gets paid if there's a deal,
Correct.
right? So they want these two to get together.
And the broker's like a realtor.
Yeah.
They are literally brokering the deal. Brokers are the conduit for how I shouldn't say most, but how a significant amount of businesses are bought and sold. And they're like a realtor. They're the listing agent. They're getting paid, to Dave's point, typically by the seller, a percentage of the sale.
Right.
And they do provide a lot of value because they've got a great relationship with the seller, but they're not representing you, the buyer, and they're not looking out for your best interests. And I'm not saying they're not scrupulous, but they are not representing you. And I would suggest you should be very leery if the broker does not want you to be in contact with the seller directly and they want everything to flow through them. You need to have direct access at the appropriate time. Typically there's maybe like before the LOI stage, there's typically an NDA that's signed, or, a lot of cases, the seller will want the buyer to sign a confidentiality agreement. So once that's signed, you really need to be talking directly and meeting with the seller. And I say it's a little bit of a red flag if the broker is like, nope, everything must flow through me. Even as a lender, when there's a broker involved and the broker says, no, I want you to go through me, stop the presses. Like, you need to have direct contact with the seller, with the buyer, and the broker does provide valuable resource, but they
Right.
can't insulate you.
As Reagan used to say, trust but verify.
Yes.
Yeah.
And some of the
But I
things
think
Katherine,
I'm sorry, Michele, go ahead.
no, I was going to say some of the things Katherine mentioned about kind of those pitfalls, the seller didn't disclose this, that, or the other thing. That's also why sometimes having a seller note is really critical, because you could have the best agreement that the seller, has reps and warranties. They're representing they've disclosed everything. There's nothing outstanding. But if there's not a seller note, or if there's not like a financial, if there's nothing financial that will impact the seller if he breaks those things, and the only way you could have recourse is by suing them, that's not always the best case, because you might end up spending a lot of money in a lawsuit that you might not get the benefit.
Right,
Having
right.
the seller hold a note for some piece of the financing is another way that, like, if you breach this part of the contract, my seller note now reduces, or it's forgivable, whatever that is. That's also a way that you can kind of protect yourself against some of those things that might happen.
Sure.
I would add two quick things, if I may.
Please.
Note to buyers: do not fall in love with a transaction. You see that's the emotional piece of it, circling back in. Do not fall in love with a potential transaction. I would also add, talking about LOIs, I was involved very recently in a matter where there was an LOI on the table, and someone said, well, I don't need my lawyer to look at this. I mean, I can read it. I understand it. It's good. Except for the fact that there was something that wasn't in there that should have been. For example, an expiration date. There was no expiration date. Those things don't go forever. So it's easy to fall into the trap of saying, I don't need this person, I don't need that person, but beware of things that you don't know, because you shouldn't know them. There's no way you would know them. So that's another kind of point of caution.
Yeah. And no matter how much you know, how smart you are, how good you are at reading this, even if you have some experience, just like in anything else, when we collaborate in business, other members of the team will just happen to see something that you've missed that day. Maybe you wouldn't have even missed it every day, but you missed it that day. Good to get a second set of eyes. I'm cognizant of our time, and there are some things that are in the chat we'll get to in Q&A. But I want to kind of say, okay, we did our due diligence. We went from letter of intent to an actual sales agreement. We've talked to our banker. Everything looks good. I know that, when I go to buy a house, generally, the terms are kind of even on the website of the bank, 5% down or 10% down. And I know if I put 20% down, I don't pay private mortgage insurance and all those kinds of things. What is that though with a business? Like how much cash am I going to have to put down? How much can I finance? Or are the kind of ratios that you're going to look at? What do I need to know about that, Michele? Or
So typically, yeah, I mean, I'll start and then others chime in for sure. One of the advantages of SBA financing is it does allow you to leverage greater the amount that you can finance when you're looking to buy a business. And typically for somebody buying a business that does not own an existing business, I'm saying, I decide I want to buy a business, we're going to look for a 10% down payment from you. Typically, that's coming from not funds that you had to borrow. Typically, that's cash reserves. And one of the things we also look at is kind of what's your cash position after you buy the business? Are you putting every last nickel in to buy the business and there's no cash reserves? Because as Mark and Katherine, we've all mentioned, there's going to be things that come up that you did not prepare for. So what reserves do you have after you put that 10% down payment? Typically, if you're buying a business that there's not real estate involved, you're just buying the business, SBA allows us to provide 10-year financing. One of the advantages of SBA financing is that there are no balloon payments, so it's a fully amortizing 10-year loan, which is much longer than a term that you could get if you were looking for conventional financing. So the typical business acquisition is 10% down payment coming from you, the buyer, 90% financing from the bank. In many cases, SBA financing is used for this type of business in this small business space, and especially for businesses where there are no assets. SBA does require that any individual who owns 20% or more of the business has to personally guarantee the loan. And if there's not enough assets in the business to collateralize the loan, we do look to the guarantors to pledge available collateral that they have. That means if you have a house that has equity in it, you're going to be asked to put to allow the lender to file a lien against your house. So SBA financing is a way to buy a business. And if you don't have enough collateral to fully collateralize the loan, that's absolutely fine. But you have to be willing to put the assets that you have as collateral for the loan. So in many cases, we provide financing to borrowers, and there's a significant amount of what we would call a collateral shortfall. But the buyer has put all of their assets up for collateral, and at the end of the day, there's not enough to collateralize the loan. If the cash flow is there, that's not going to be a reason for us to decline the loan. So typical terms
goes back to almost those comments that we all talked about in the beginning of the process. Understand, you're going to have a lot of skin in the game.
Correct.
And this is not just an adventure like, oh, it didn't work out. I declare bankruptcy and everybody else, and the bank's out of the money. No.
Right. Which is why you need, and Mark said this, take the emotion out of it. You need to be able to walk away from a transaction if things don't feel right, because this is your life. And it's not pretty if things do not go the way we all hope they go. And you just have to remember that when you're going into it. And there's nothing wrong with, before you sign a letter of intent, as you're looking at businesses, talk to different lenders. I can't tell you how many times I've talked to buyers who have maybe looked at 2 or 3 different businesses before they settle on the one they're going to buy, and they bounce those businesses off of me. Can you look at these financials? How much financing do you think we might be able to get? So building a relationship with a lender early on is also important, and a lender should be willing to talk to you about a deal, even if that deal might not happen. That's part of kind of building that relationship.
Sure. Yeah, if it's a banker that you've worked with for years and knows your personal finances or other business finances, that's obviously helpful, but that doesn't mean you only go to that banker.
Correct.
There are other fish in the sea, right?
Yep.
Yeah. So as we try and move to Q&A, do us, ask Mark and Katherine and Michele, is there anything that we didn't talk about that's really important, things that we kind of didn't get to yet? Because we could keep talking about this for another hour. But is there something now at the end of the deal that was like, oh, don't forget this?
Just gonna
Is there anything else?
say, we talked a lot about like doing the deal and kind of getting through to closing, with like a thinking about the future, but there's something called a non-compete, that a lot of people kind of forget about. And so, just like it sounds, the idea is that a lot of times sellers are selling the business because they want to retire. And that's great. And most of the time they will take their money, they'll move to Florida, and they'll be available to answer questions, and that's really it. And you move forward and run your business successfully. But every once in a while we do see borrowers or sellers who do it for a year and then they get tired or they get bored and they want to come back and kind of enter into the industry. And so I always recommend getting some type of non-compete, whether it's 1 year, 3 years, 5 years, whether it's in Montgomery County or Pennsylvania, Delaware, New Jersey, whatever it is, depending on the business, could be something that's negotiated with the seller. But I do recommend getting at least something to give you time to
Sure.
really develop your business, your customer base, and make sure that people trust and like you, so that even if the seller did come back in 3 years, that they're like, well, but you're my guy now, right? Like, this is where I'm going. He left already, I'm not gonna go follow him. So that's definitely something to think about. There are other aspects you want to talk to CPAs, attorneys, bankers about moving forward, your working capital, different things that you can be doing going forward. So it doesn't just stop, like we're giving all the advice on like how to buy your business, but remember, there are other things you need to do to sustain your business that
I
can
would
be
think-
done at
yeah.
the time of buying.
I would think on non-solicitation as well. Don't come back
Right.
and get my best workers who used to be your
Yeah,
workers,
so they
right?
can't take your employees.
Yeah.
And we get creative. We can carve out things where they can buy, they can buy on the Wall Street, stock market, so a similar business that they would own less than 5%. Like, right, there's all these different terms that we're familiar with. You're not going to ask them for anything unreasonable. Anything you need to protect yourself and protect the ongoing, business, which they want, right? Because they're not just closing the doors and leaving, right? The seller wants the business to go on. That's why they're selling it.
Sure.
So, any of those questions, any of those things are not unreasonable. And if a seller or a broker, I think Michele mentioned this, makes you feel like that's unreasonable, then I would definitely take a step back and reassess and make sure that you have someone in your corner, and that, you are being truly reasonable, and that, why aren't they, willing to play ball?
All right. So very quickly, one of the questions was about, hey, can we just use our family attorney? I don't want to put words in anyone's mouth, but I would think in terms of whether it be the CPA or the banker or the attorney, great if they have experience in business transactions, but the person who did your will doesn't necessarily know anything about doing a business transaction, or the CPA who does your personal taxes may not do business taxes. So make sure you have some expertise in this kind of transaction.
Right. I'm not going to go to an orthopedic for heart surgery, right? Like, so you're not going to get your business purchased by someone who's doing well. So, I mean, I think that a family friend might be someone that you want to, they might be helpful for initial questions, right? They might give you some of that
Right.
initial insight. Like, they might, remember red flags from when they took contracts years ago and things like that, or they might be familiar with it. So they might be able to help you kind of maybe in that initial conversation or in the LOI. But I would talk to them, right? If my family comes to me and says, I want to buy a business, I'm going to say, hey, like, I can obviously talk to you intellectually about it, but at a certain point, I'm going to have emotions too if you're my brother and I see someone treating you some kind of way, right? So we have to make sure that we're being transparent, and that, there's someone that they're going to have a conversation with you and tell you if they need to take a step back, or if they feel like they can truly represent you through it. But I wouldn't, if you're doing like, if my brother was buying my dad's business and they said, we want you to represent both sides, I would be happy to have some of the initial conversations, but I do think I would be weary, because what if there's something my dad didn't tell me just because he didn't know or didn't think it was important, and then there's something that could, or my brother isn't aware of, or he doesn't succeed, or now he's in default on a loan. Like, there's just a lot of things that can make Thanksgiving a little more awkward than I would like. So, I mean, I personally would kind of take a step back, but I also think, again, it's find the line on like, what can they help you with to save some money, but then they should also be able to to help you identify a good attorney, a good CPA, someone that they'll vouch for to tell you, like, I think that they'll, you know, kind of help you through this. And I saw a comment on ChatGPT. I will say ChatGPT, any of that AI stuff, it is helpful to an extent, but it's only helpful to the extent you know what prompt to give it. So if you know to say, here, I am negotiating an LOI for this type of business in this industry, and here are all my key concerns, what are the other concerns, and blah, 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 and you give it the right prompt, it can get you probably about 70% of the way there. But if you just say, like, I'm buying a business, what should I consider? It's going to give you the most generic stuff that it will help you in an initial conversation, but it's not going to catch a lot of that
It
diligence.
can get you
and stuff.
70%, but it might make up the other 30%. I mean,
Yeah,
so
it might make it up, or it's just not going to
aware of
know it,
that.
and you don't know what you don't know either, right?
Right.
So I think it's good to help you get some basics. Maybe, you know, me, I'm not a CPA, I'm not a tax person, so I might want to be like, can you explain cash flow, financials? They use these terms, balance sheets. Like, can you ChatGPT? Can you explain what these are and how they relate to purchasing a business? And then it'll give me the terminology. So then I can then sit down with Mark and go through it at a higher level. I think that's certainly helpful, but I'm not going to rely on ChatGPT to buy my business.
Write the agreements. Yeah. No, good answer. So here's a very, I'm going to say technical question, and I think important to understand. And this question says, can a seller provide seller's financing or a note if they have an existing SBA loan on the business?
So yeah, I was looking at that in the chat, and they can. So typically, if I'm a seller and I have an SBA loan on my business, when I sell the business, the proceeds of that sale are going to pay off that existing SBA loan, because from a buyer side and from a lender side, we want to make sure all of the debt that that seller had is paid off. So they really are separate. So on the sell side, if the seller has an SBA loan, assume after the transaction that SBA loan is going to be paid off, or any financing is going to be paid off, so they can transfer clear title to the buyer. So yes, a seller can provide seller financing, and hopefully that answered the question if I interpreted it the right way.
Yeah, thank you. And there's I want it's not a follow up from the same person, but and Katherine, you kind of got into, you know, generally speaking, the person is moving on in their life. They want this company to be successful because they put their heart and soul into it for 10, 20, 30 years, you know, might have had their name on the front door, everything else. What do you guys think about keeping the person around in a diminished capacity? They're no longer the owner, but maybe they're the salesperson or a consultant, or, you know, essentially like of counsel, whatever we would call of counsel in a different kind of business, right? You know, is that a good idea, bad idea, fraught with dangers? You know, sentimental is nice, but
We
time
get the classic "it depends," right? Like,
Yeah.
if this is someone that, like, you are having a good experience with while you're purchasing it, and you can see a clear value, you know, for SBA financing, the general rule is a seller cannot stay on for more than a year, and the seller should only be helping you to transition the business. So I do think with most businesses, especially service-based businesses, it is not a bad idea to have the seller stick around and do some type of transition. Now, whether that's a day, a week, a month, a year, like that, it's really going to depend on, like, you know, how long do you guys think it'll take you to really get your head wrapped around the books, the contracts, the employees, you know, like, you want it to be a smooth transition, right? You don't want to all of a sudden, like, this, the seller's out and you're parachuting in and figuring out how to run the business, especially if it's something like assisting with seniors or healthcare or something where, you know, they really kind of invested in the person. They want to know that this person is now transitioning their contract, their needs over to someone that they trust, right? Because if you trust that person, and then you're probably going to trust the people that they trust as well. So it's usually good to have something. But I would be wary and make sure you're having clear conversations on, you know, what is the seller doing? You know, they're not staying in, they're not still running the business. If they, you know, they need to understand that if you make decisions that they don't like, that it's not their business anymore. And you want to make sure they're not bad mouthing you to employees or bad mouthing you to customers because they get upset about something.
Right.
You want to discuss their compensation. Some of them think that, well, if I'm staying on for another year, then I should be getting a salary. I should be getting healthcare. You should pay for my car. Like, you know, right. Like you want to negotiate all of those type of things and then see how they react to that. Like, are they, oh, of course, I'm just here to help you. And I've seen it do all different ways. I've seen them work, you know, almost full time. I've seen where they're hands-on for a month and then they're available by phone for 3 months. Like, again, like all of that stuff is negotiable, what they're willing to do and what you think will actually help you with the business.
Sure. Good. All right. As we wrap up here, Will, Michele, Mark, Katherine, thank you very much. Are there any final thoughts from any of you, member panelists?
I would say real quickly, Dave, one last thought from my perspective. Beware the dreaded rules of thumb. I've heard many times over the years, oh, everybody knows that these businesses are worth 5 times EBITDA, cash flow. Until you get into the details, then they're not. So I would just add, beware the dreaded rules of thumb. Those are usually from 1,000 feet up. There's nobody to talk to when things get derailed, and they're really, really dangerous.
Okay. Good place to end. I want to thank everybody for joining us today. On behalf of the SBDCs and Customers Bank, I'm Dave Patty. It's been a pleasure to have you with us. As we said before, the recording of this presentation, as well as some things to leave you with, some thoughts from each of the presenters, will be provided in coming days. If there's anything the SBDCs can do for you and your business, please check in with your local center or through the statewide website. Thank you all, and we'll see you at our next event.
All right. Thank you so much, everybody. This was awesome. Really appreciate it. So we got some really good feedback here. How did everybody think it went? Any sort of feedback?
It was good. I thought it was a really natural, really natural conversation. And
Yes.
we definitely could have talked longer. We definitely could have
Yeah.
talked longer.
This is a really complex topic, and I think we blended well.
Good. I thought the three of you did a great job. Really, really good responses, and there was good chemistry there. I think we're ready to take it on the road.
And Dave, thank you so much. I mean, you did a great job keeping the conversation going, putting your own spin to it and flair. And very impressed. Thank you so much.
Sure. All right. Thanks,
Good,
guys.
I'm glad. Happy to
Alright.
join.
Yes, thank you, everybody.
See you
All right,
later.
take care,
Thank you.
everybody.
All right,
Bye-bye.
Bye.